Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Welcome back to the show. Phil Tarrant, host. I'm actually the host of the Smart Property Investment Show. I do a fair bit of podcasting these days, but this is the podcast that I still control and own rather than having to share it with other people, which I like sometimes. Lots happening at the moment. Watch this space. You'll see some chats coming online with some people who you probably know, having a look at some of the reforms underway in some of the different jurisdictions. Obviously, we know up in Queensland there's been a lot of changes to rental regulations where, this idea if you can only increase rents once a year is now got to be linked to the property rather than the tenant. We'll give some more details on that. There's also this no grounds eviction stuff that's coming out in New South Wales, which the state government's testing at the moment, trying to work out how they're going to shape and move that. And there may be some consequences to property investors around that. We'll cover that off. And also what's going down in Victoria, making it very difficult for property investors to invest down there. And some of the numbers I'm hearing are quite alarming in that the number of rentals available investment properties available, rentals available in Victoria is shrinking rapidly, which is a big issue for those people who are looking around down there. And that's largely as a result of changes to rental regulations by the state government there. And I think they're out of control. But anyway, I'm bringing someone in who's going to give us some pretty good narrative around those type of things. But that's not what today's discussion's about. It's about bringing someone back onto the Smart Property Investment Show. They haven't been on it for 3 years, and there's good reason. Number one, they weren't very good when they first appeared on it, so they've been in training, trying to work out how they can do their job better. Number two, because a big thrust of their business has been outside largely of residential property investment in the commercial space, and is doing very well in that regards. And number three, because I still see him all the time because he's my co-host on the Inside Commercial Property podcast with Rethink Investing, and that's Scott O'Neill, the director over there. I'm bringing him back in to the Smart Property Investment Show. I've kept him waiting for a long time. I'm sure he's going to regale us in some good stories around residential property. Let's work out what's going on, see whether or not he's back in residential property. Maybe there's a sign. I don't know, Scott. Welcome.
Thanks, mate. Good to get heckled. It's been 3 years.
It is. Remember, Overdue. This is my podcast. It's not a shared thing, so I'm in control.
Can't edit this out either.
Can't edit it. No, there's none of that, right? You can't. You've got no authority now. What you say goes. So you're stuck. But 3 years. But in that 3 years, we are just about, from what I understand, to hit our 50th episode on Inside Commercial Property. That's crazy.
I know. I can't believe I've known you for 50 months. It's a lot.
It sounds like a lot, doesn't it?
It's getting up there.
Nothing's really changed, has it?
2 months or whatever. Yeah, it's up there. So, yeah, no, a lot's changed in that time, and good to be back on your show.
Yeah, well, it's still as popular as ever, and it's really good. I was out with your folk at an event the other week. You sort of did a bit of a sort of intimate discussion. You said it was all high net worth individuals, so I don't know why I was there. I think you just dragged me out there to try and moderate a panel. But I met a lot of people there. It was a really good function where you brought in some of your clients and prospective clients and other people who were interested in commercial property. We had a really good discussion around it. But it was nice that so many people come up and said, Phil, really love the stuff that you do on the Smart Property Investment Show and also Inside Commercial Property. And you sort of get this narrative and you get great satisfaction out of it where people say, listening to you has actually made me do things which has completely changed my life. And you go, that's pretty cool,
Yeah. Well, look, the Smart Property Investment Show, that was my introduction to podcasts. Literally, I don't know how long you've been doing this for. How long? Is it 10 years?
Nearly 10 years, yeah.
So, yeah.
We cracked 1,000 episodes recently.
That's a lot. How many have you done? Not all 1,000?
No, probably most of them.
Wow.
Yeah. I reckon I've done, probably 1,000 of these, maybe 950 or something like that.
Well, I remember listening, what's that, 2014?
Yeah, started 2015, I think we started.
No, I was about 4 or 5 years into investing myself, and I was just starting to get a portfolio that was decent sized, in my opinion, and then I was listening to all your stories on this, and it got competitive. You go, that guy's got a big portfolio. They've been doing it longer. What can I learn from them? Oh, that guy is more development. This guy's into duplexes. This is a new starter. Like, it was really good hearing all these different stories, and it kind of pumped you up to stay on the course as well, because the magazines were dying out at that time as well, and this was kind of taking over as the new medium. And yeah, it was a good, like almost a measuring stick. What else people are doing, and then you had your OG buyers agents, which was great. I was starting my buyers agency at the time, so just hearing what they were doing, very different strategies they all had. So this was before it was a mainstream industry, so it was like the first insight into what companies were doing as well. So I found it fascinating, and it kind of, I guess that's why, I don't know how I got into the podcast the first time, but it was a really good introduction, and it kind of shaped a lot of my career in the buyers agency.
Well, and people using podcasts like this, and some other very good other podcasts out there. There's a lot of property podcasts out there these days, though.
Every company's got one now.
Everyone's got one, and I sit there and I guess you inside commercial property, which is pretty unique in that I think there's only a handful of that stuff, but you're the OG buyer's agent for commercial property, really. It's in some ways you've helped create a market segment, and I think that Inside Commercial Property podcast has been a great enabler for changing and shaping people's opinions towards commercial property, and it's probably made commercial property a lot more of a understood asset class now, and people are probably taking action around it. But this podcast, we were the first to shift away from doing the Smart Property Investment magazine and went, no, that's not the future. The future is podcasting. We went all in on it. And still today, it's probably the biggest, or one of the biggest property investment podcasts in Australia. But it's the only really sort of independent one, if you want to call it that. Normally everyone sort of does something else, right? Yep. Whereas this is actually just an idiot journalist chatting to people, right?
But I think that's why I liked it, because everyone's pushing agendas, and there's a lot of this kind of in the stock market world and that. But the property, like you said, it's generally company backed, and you're almost a spokesperson for buyers agents in the early days, and it helped. And it's funny, I've been because obviously we're launched into New Zealand, so we're talking to a lot of New Zealanders. It's the go-to podcast for most of them as well. So
the Smart Property Investment,
one of the Australian ones, because they don't really have that resource like we do in Australia, especially with the commercial. I've been finding all the commercial agents over there listen to our Inside Commercial Property one, and that's it's not even catered to them, but it's still very transferable.
Are you going to do a New Zealand version of that? Thinking about it.
Oh, look, we'll talk about New Zealand in our podcast, because it's so transparent. So one of the guests we'll get on that in a month or two would be one of the top agents in New Zealand, like one of the OG guys of the biggest companies. So he'll talk about everything New Zealand.
Are you going to fly me out to New Zealand to do this in person? I only sit at the front of the plane, and
well, he's coming here.
Oh, is he coming here?
I kind of want to. I would prefer the other option, but it's he's over here this. In July or August anyway, so may as well get him here.
I like going to New Zealand. We got team members out in New Zealand, so I get out there.
Yeah, wait for the snow to fall. Go down to.
Well,
Queenstown.
I'm actually out there in August for a week
skiing.
For work, a sort of work conference out there, but it just happens to be in Queenstown when the snow's the best.
Perfect.
But I did a lot of snowboarding.
I'd pay to see you do a bungee jump.
Me?
That'd be good.
Oh, no, I don't mind. Yeah, I've done the bungees in my youth, but I'm so risk averse these days that I even go like snowboarding, going, I just don't want to hurt myself. I fucking just don't want to hurt myself. So I'd rather not. I'm sort of quite happy drinking Jaeger bombs in the chalet rather than hucking myself off cliffs and stuff. But so you brought it up, New Zealand. Why are you going out there? Like, this is not what I want to talk to you about, but you bring it up, so I'm quite curious.
Well, mostly it was the demand. So we've been approached, and probably because of the podcast, and it's been about 2 to 3 years of people asking, are you guys, can you help New Zealanders? Can you help there? Australians wanting help there. The reason I hadn't got into it 3 years ago was the interest rate versus the yields over there. It was a little bit off whack, but we're in this market now that prices have come off about 20%, depending on the market. The
resi or commercial?
Well, both.
Bit of both.
Yeah. It's similar. So it's about 15% down from peak in places like Auckland, and there's different segments of the market that have variations to that number. But the interest rates are just like Australia. There's talk of it coming down, whether it's December this year or February next year or April next year. It doesn't matter. It's the talk. Like, it's going to come down at some point. And at that point, the value's back in the market, especially off the lower price point. So I think there was like an opportunity to make money.
Yeah, fair enough.
They're going through record immigration levels, just like Australia. It's almost like whatever's happening here, it's happening there to a similar degree. They've got a housing crisis. There's shortage of homes. The build costs have gone up. There's all these new people fighting over limited building approvals. It's just slightly different variations. There's some better tax outcomes there, like there's capital gains tax and stuff like that are treated differently.
Yeah.
It's cheaper as well. Interest rates are higher, so like it's almost a diversity play too.
Yeah. It's quite easy, I guess, to shift money around from Australia and New Zealand. I've always sort of been semi-reluctant sort of investing internationally because you got to start worrying about all sort of
but it's so different
currency
in New
risks
Zealand.
and all this sort of stuff. It pretty much. I'm probably going to get hated. It's pretty much the state of Australia, right? Like it should be. We all play the same football game and rugby and rugby league.
It feels that way.
It feels that way. So
slightly different accent, but
they speak a bit funny out there.
People in Adelaide have different accents, and
I like New Zealand. New Zealand's cool. I could easily buy a batch on the beach out there and retire out in New Zealand. I think New Zealand's a great place.
Beautiful homes, and look, it's all the same banks. Like I opened a New Zealand bank account online without any involvement on someone on the phone, and it's just then you've got a New Zealand bank account.
So have you officially
Western.
incorporated out there now? Like, you got
so you need real estate agent license. You got to get all the same.
You've
tickets.
done that. You've gone and got all the tickets.
So individual license, company license. It wouldn't work for residential, I don't think. So we're not going to target residential property there.
Only going to do commercial.
Yeah. And it's because the interest rates, the yields are terribly low. I'm sure it'll work, but they're a property mad country just like Australia. So it feels a little bit at the wrong time. Again, everyone's got different opinions. Then there's different markets. Like someone asked, you're Australians, how do you invest in New Zealand? And my answer is it's like a Sydney-sider investing in Perth. You just learn the market. There's different rules. There's different economic drivers in the market. You use locals to source properties. That's what we're doing. So we've got locals, New Zealanders, 10 years experience in the game, finding properties.
Do they have buyer's agents in, it's a stupid question, but do they have buyer's agents in New Zealand? Is it a thing?
Compared to Australia, they don't.
Okay.
I would say I'm sure there's some little companies out there here or there, but I've done a strong Google and it's very hard to find any competitors out there. They've got fund managers, small ones. They've got some residential guys. But again, there's no industry like they've got in Australia. Like what have we got? Thousands of buyers agents in Australia.
There will be now.
3,000 or 4,000 maybe.
Yeah, I reckon when we first started this podcast, you would have had less than 100.
Yep.
In Australia, and we've seen that grow. And look, maybe we're partly responsible for all the buyers agents that are out there and around there. But how many people I've had on the show as guests over the 1,000 episodes we've done who are now a buyers agent, I could probably count hundreds of them, which is cool. But New Zealand's they've had a bit tough lately. They've had the most recent previous government did quite a lot of damage for property investors in terms of changing taxation rules around negative gearing and all that. They did all that stuff, and they've got a new government. They're changing that back now. There's you had a government which wasn't favourable to property investors previously. I think now the current government is scaling back a lot of those mistakes that they've realised that they've made.
And the thing about going into a different country, I love seeing this because as an investor, it gives you more context. Mm-hmm. So as Australians, we can't rule out this type of thing happening in Australia. We're very used to negative gearing, and you've seen what they're doing to land tax in Victoria. If the polls swing a certain way where enough people don't like capitalist property investors, votes will be gained by making decisions against property investors. Yeah. So you got to plan for that. I've always thought worst case scenario when I buy a property, I think if the GFC hits tomorrow, can I hold this property? What if it doesn't rent for 2 years? You got to got to not throw the kitchen sink at your portfolio. Like you can if you can cover the cash flow and you've got multiple streams of income, you can take more risk. But yeah, seeing what happened in New Zealand was a good thing. Just as context, like maybe in the next 10 years, Sydney might have some land tax rules change, or they'll limit the amount of properties you can buy. Who knows? And it's just good to think like that. And yeah, seeing how heavy that other government went against property investors, and now they've made a mistake there because there's not enough rentals.
It's a country in recession, let's remember, and it's got some significant housing problems, right? So is the juice worth the squeeze for you guys? Like, isn't there enough for you to do here in Australia without going?
It's a good question, because remember, it's the size of Sydney population-wise. It's not so much a revenue creator thing. Like I'm really doing things to do things differently, new things in business. We had the renewables energy chat.
That was interesting. Yeah.
Yeah. And again, it's that business will cost me more than I earn because it's a cash intensive thing. Yeah. It's like, it's like squirreling money away for a small cash flow, but then you're putting cash into solar panels and batteries and stuff like that. But we might be doing 5-10 deals a month there. Like compared to us, Australian operation, it'll be a fifth if we're lucky of the size. So it's not, like we could probably make more money in Australia, but again, it's nice to be the first to do that.
And even if it's the application of diversification strategy for your clients, if you're able to provide that as, it's hedging your bets even further. If things go less favourable in Australia, but you get better conditions out in New Zealand, if you're in the game, you're going to buy out, you're going to be the first, you're going to...
Yeah, so we've got I've got my first personal brief over there, there's
they love Kentucky Fried Chicken out in New Zealand. You got to buy up all the KFCs. I've got a lot of Kiwi friends, so I'm okay to say that, right?
No, it's very popular. They've got all the Woolies. It's all the same brands almost.
Yeah.
But
Countdown.
There's a brief I'm looking at, which one of the locals put me on there. So you know how they got earthquakes there?
Yeah.
They've got earthquake ratings where a lot of them have got ratings that you can just spend a little money on it that lifts it into a more safe rating, and that means you can make finance a lot easier. So it's like buying a building or a warehouse that's got a risk on it, but then you can remove the risk through spending a bit of money. So it's like a value add play. So I got the brief out, a guy on the ground's looking for something like that.
So you can buy a joint and make it more earthquake proof
Yep.
and make it more attractive to borrow against, and therefore make it a better asset means that it's worth more money.
Exactly. So you get the engineers out there, you do what you got to do to the building.
What do you know about earthquake? I know you're a civil engineer, aren't you? No, mechanical, civil.
Yeah,
There you go, mate.
I remember.
Who knew? Look at you. You're going to be sitting out there with your jackhammer putting concrete piles in, are you?
I know. No, I remember from engineering, it's all about simple harmonic motion, and depending on the frequency of the earthquake, it would knock certain buildings over and not the others. I've got a big book at home from university.
You probably say, I remember I did engineering science at school.
Yeah.
I didn't take it to university, but you were sitting at that famous bridge.
Wobbling.
Which is the simple harmonic motion stuff.
Yeah, and the ones that don't flex enough, like all buildings flex. Like those, the Q1 probably swings 10 meters either side on a big windy day, but you need the flex as a bridge does, because it expands through heat. So you've got expansion joints through it. But the reason a lot of the issues happened in Christchurch was they just weren't built for that earthquake that happened, and it flattened most of the city.
So I'll put you on the spot then, seeing that you're an expert in New Zealand commercial property. What do you like out there? For all of our Kiwi listeners, welcome. Maybe we should do some more Kiwi stuff, but what do you like out there?
Same stuff in Australia. So secondary industrial space. So not the big $20 million stuff. The yields are too low. So we like
or new build industrial. Stay away from it.
Oh, new build is good at the right yield.
Okay.
The problem is new builds cost a lot, but if you get a new build at the right price, because remember it's a down market, it's a buyer's market there. So if you can negotiate a good deal, which you can, that's one of the most attractive things. You can get a better deal than comparably to what you could in Australia. So in secondary industrial, where it's maybe a bit of an older shed, bit of land, the yield's good.
Yeah.
The demand for that stuff's through the roof from a leasing point of view. Essential retail, like medical, all the same stuff. It doesn't need to be in Auckland. Auckland's the lowest yielding city. It's like buying in Sydney. It's tough to get there, but outskirts of that, you go to Dunedin, Wellington, Christchurch. Like you'd look at all those places, and even like they're very negative on some of their regional areas as well, just like probably Australians were 10 years ago. But if you bought a house in Rockhampton or I don't know Sunshine Coast or Goulburn, places like that, they've had a good 10 years. So it's all relative. You just got to make sure it's a town that's got the right fundamentals, and you're protected by that.
So how much dough do you need in order to get yourself good stuff out in New Zealand? Because
7 figures, you still need your million bucks, I'd say, but you can get cheaper assets, definitely. Like it is lower cost. It's the New Zealand dollar as well, so you shave off 10%.
It depends. Yeah.
Yeah. So if you put a mill and a half into an industrial property over there, you're doing quite well. You can get your 8%, 9%. A good quality asset, you're probably 6-7%, just like Australia. The interest rate is the big difference, though. So anyone that's just going, I'm going to go look at New Zealand, the average interest rate for a commercial loan right now is 9 to 11%.
Okay,
much higher. And this is one of my, my loose predictions. I think New Zealand banks are overly harsh towards commercial because, I'm used to the environment with Australia. Banks love commercial at the moment, so it seems like
banks here are still doing like lease stock really easy as long as you've got a deposit.
Yeah.
They'll lend you the money, standalone, right? They don't need to see anything else. They'll lend it against the asset.
Correct.
Yeah.
So you've got those products out there, but the interest rate cover is hard to hit when you're paying 9% on an interest rate. So the opportunity right now is if you can deal with the rough interest rate, so you might put 50% down on a deal, but then a year's time, the interest rates will be lower. The yields you're buying at a very high yield anyway. I think there'll be a gain to be made. And if banks loosen their policies, which if you look at Australia, they should, because it's basically it's such a similar market if you break it down to a suburb level. I just think there's room for improvement there, and that's all you need.
Okay. Well, thanks for the update on where you're at with all that. I've got 1,000 questions around it, like going, okay, well, and when is the time to diversify? Why would you buy there rather than get some in Australia? How hard does it get your money back? What's the tax implications? Blah, 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 blah.
Well, we'll talk about we'll get one of the best experts.
Yeah, we'll do that on our Inside Commercial Property.
Yeah. And that'll be a first. I'll learn a lot through that just through, he'll have 30 years experience.
We'll bring
selling.
a translator in. He's got a funny.
Yeah, exactly.
You send your hate mail to, all right, welcome back. Phil Tarrant, host of the Smartphone Investment Show, chatting with Scott O'Neill, founder, director, Rethink. What you called Rethink something these days? There's a big new, it's not the Rethink, it was still Rethink Investing, but you got Rethink Everything these days. So what's the group called?
So it's just called Rethink Group. But under that, we've got Rethink Investing, Rethink Financing, Rethink Renewables, Rethink Commercial Education, Rethink Property Insurance, Rethink Property Lawyers.
Do you do property insurance, do you?
Yep.
Commercial or resi?
Commercial.
Okay.
Look, we do resi, but it's...
So you're just a broker, are you?
What we found with the insurance, because commercials, it's not just like going to Budget Direct and going, plug your details. You need surveys to get done sometimes. Yeah. You need someone to go, there's a gantry crane in that asset. There's it's over 5,000 square metres, so there's only 3 policymakers in Australia that will insure it above that latitude. There's all sorts of weird things.
I didn't know you did that.
Yeah, so you got to go into the specifics, and if you get insurance wrong, you don't get paid out. So controlling that for the client's benefit is it's almost a must.
Okay, so Rethink Insurance, that's all the rethinks, or any other rethinks?
A couple more coming for a rainy day.
All right, okay, well, let's not worry about that. But maybe a consequence of the success of the Inside Commercial Property podcast, people think that you only do commercial buyers agency, but you still do resi stuff. That's what I want to talk to you about. So you haven't given all that up?
No, look, I started in resi.
Yeah.
I love resi. I started that business helping my family. They were the first guinea pigs besides myself.
Who's the first person you charged? Did you charge your family? You should have. I hope you did.
No, I didn't. I was doing an MBA.
Yeah.
And then somehow I spoke about this business that didn't exist at the time, I was starting it, and helped them buy a couple of properties. And I charged $3,000. That was the fee. Just,
Resi.
That was my fee.
Have you got an MBA, have you?
Yeah, we I can't remember what year.
How's that? Worthwhile investment?
Do you want me to be honest?
Yeah.
Probably not. No.
Probably what, 40 grand?
No, it was 100.
Hey, you spent 100 grand on the MBA.
It was 110. So it was AGSM.
Strange Graduate School of Management. Good school.
Yeah,
New South
Uni
Wales.
of New South Wales. It's. I didn't finish the last year because it was all like you had to stay on campus and that kind of stuff. And I had this business running. Like the reason I started it, in a previous career, I went to uni and I was going to do the corporate thing. Like, so my career dream was be a CEO of a ASX listed company, something like that. Because I like the management. I kind of had a natural, I don't know, I could deal with the corporate side of things without too much effort. And the career was going good. So I was getting promotions at work and thought, all right, well, I was managing about 150 people when I was 26 at the time, or 25. And then my next job was the New South Wales GM role. And I spoke to the boss and said, oh, how do I become that? And he said, well, you need an MBA for that role. So I said, oh, would the company pay for it? And they said they'll pay half. So I started it, and then I realised doing the course that it was really old school stuff. And that's why I was starting to get interested in property. And the bit that did it for me, where I kind of said I'm not going to progress that last year, was the marketing. Because I was doing Facebook marketing, all this stuff that all the buyers agents just do naturally. And it was just really old school, like Manslow's, type of theory, like needs, like all that kind of stuff that is about like the, understanding the marketing side of things from a theoretical point of view. And I wanted practical stuff. I wanted to know, how can I make this business more well-known, and it just wasn't that. It was just old school, and it was costing a lot and taking a lot of time.
It's funny, right? Like other people that get university degrees, they sit there and go, like, often it just gives you a ticket, right? Ticket to play. And if you want to go corporate life, I sort of did undergraduate and postgraduate degrees, sort of, bachelor's and master's degree. And I started also out at University of New South Wales. I sort of got about halfway through, maybe 3/4 of the way through.
Didn't you do university in Lebanon or something?
Yeah,
like
it's all over the joint, But I started a Masters of Commerce out at University of New South Wales, through the Graduate School of Management, and I did it because we're doing a lot of like market research stuff, and I went, well, if I'm going to do that and talk about this stuff, and what I should get a ticket, right? So I started the course and did sort of a half or maybe 3/4 of the degree. I remember just sitting there like you, just going like, it's just a waste of time, right? Like, I'm not saying that university education is a waste of time. I think it's really good and important if it's right for you. But a lot of people get caught up on the idea of having to get these big degrees, when often the application of them or practicality of them is, once you sort of get beyond or say in your career, you sort of go, well, so what? You're better off spending money on maybe properly related education.
Yeah. I think the key is balance. Like you need a ticket for many jobs, especially the big ones. Like, if you want to be on a board of director, if you've got no tickets, you're probably not going to get it. But it's the guys that I found, because I did an engineering degree, and that's a lot of overseas nationals and non-English speakers. And I remember when I finished, like I actually did my thesis on how little it'd be controversial, how little the university degree prepared you for the real workforce. We surveyed thousands of students, postgrad students, and literally quantified which were the most useful subjects to the least. And as I was sending all these surveys out to the alumni, I had hundreds, because I sent it from my latent contractors email at the time, because I was already working as a undergrad there. And I had hundreds of people say, do you know anyone that can get a job there? And I started talking to a bunch of them, and some were like 3-4 years out, still not in engineering. And it was because most of them had no other previous experience. They'd never worked a job digging a hole, serving coffees. And
well, you were in a bar, weren't you? So you were at RSL or somewhere or other.
Well, my engineering boss, he said, look, you need this, but the reason I hired you is because of that. And he pointed at the McDonald's experience, literally. So I got my job because of McDonald's. And I only worked there for, 2 days a week for a year or two. But
it's enough.
That's what set me apart from I remember there was 1,800 applicants and they hired about 20. So, and most of them were pretty.
But they didn't want
really good
robots, right?
operators.
They want, the idea with that is that they assume you've got the technical capability to be a graduate.
Yep.
If you've got a university degree, and I'm sure you've probably got a reasonable score. But they want people who are connected and have empathy and all that sort of stuff, right? And you get that through experience,
And most of the job's not technical as an engineer. Like all those fluid dynamics equations that go for 3 pages, you don't do that. Like that's, I'm sure this, if you're doing a high level structural, frame job, you'll have to.
But that's
break
someone
down.
normally in a back room that doesn't really get let out the light of day, right?
They're doing programs that do it all too.
Yeah,
Especially now.
But property investment is very much the same, right? It's the practical application of it. You can run the numbers, you can get boffins to do whatever, right? But good, smart application of property investment, you need people-based skills, right? You've got to negotiate, you've got to find people that you like, you can work with, real estate, all this sort of stuff. But an MBA, it's funny how many people get degrees. I actually did my undergraduate thesis was in propaganda.
Wow.
Which, to be fair, I use a
Do you
lot.
still do that?
Yeah.
Property propaganda.
But it's all about influence, right?
Yeah.
And I work in the business of influence, like media. It's you influence, you inform people.
Yeah.
And one of the biggest issues you have in the world today is disinformation and misinformation, right? Which happens in real estate, like you wouldn't believe, right? Like just open your Facebook or your Instagram and you're going to have scrolling through hundreds of people who are all property experts, right? Telling you where you should and shouldn't be buying property. Like, and if that's good, credible information, brilliant that you can act, that will shape your perception and you can act upon, fine. If it's incorrect and biased misinformation or as deliberate disinformation, as in someone deliberately putting false information out there to change and shape buying behaviours or actions or habits for whatever reason, often nefarious, like that's bad. It's propaganda.
Well,
Like,
that's how World War II started.
that's
wasn't
propaganda.
It? Yep.
It's all propaganda, Social media is largely propaganda. It is. It's just people say, hey, I reckon this and this is the reason why. Okay, well, why are you telling me that? Because you want me to buy something, do something, whatever.
Yeah.
But, so at least I got some utility out of my undergraduate degree when I look at it through the lens of property investment. But be careful, be warned, right? Like, everyone's an expert. We've been doing this podcast for 9 years or 10 years, whatever it is, 1,000+ episode, 50 episodes now with you on Inside Commercial Property. Like, there is no bias or agenda with that podcast other than, let's be clear, give people information around how to effectively to educate them on property so they make better buying decisions. But, what's the outcome of it? You want them to use you to do it, right? That's okay. That's fine. People know that, right? There's nothing really there. This particular podcast, Smart Property Investment Show, it's like, why do we do this? Well, I don't want people to make stupid buying decisions. Like, that's why I do this.
And you get found out as well. If you spread incorrect information, like time will expose those lies.
Yeah,
And
time will expose those lies. And people get caught out and you see these property spookers come and go, right? Podcasts like this, Kevin, I was saying, look, there is a commercial objective to this as well. Like people advertise on this. You hear an audio advert, right? That's how I keep the lights on. But it allows me to do this, which is pretty cool. Allows you to do what you do, buying property. Yeah, you buy property yourself, but you also do it for other people. Keeps your hand in the game. Action speaks louder than words. You're probably one of the most prolific commercial investors at the sort of brackets that you invest in.
Yeah, and that's why, we wanted to talk about residential because the thing with commercial is it's getting higher priced as well. The stock is, you're talking 70% plus down from peak levels. Like there's not much of the stuff around. Prices are going up. Seeing great capital growth rates, but it is a high risk asset class, and we get literally 80 odd people on average reach out to our company, and I'd say 70% of them would not be suitable for commercial. So we've always stayed in residential for that reason, and I've never, put down residential. Like it's got limitations for sure. Like the obvious one is the cash flow, and it's hard to scale a portfolio there now with your current interest rates. But it's an incredible way to build wealth. Like if you're starting out and you got 100 or 200 grand, you don't go to commercial, you go to residential.
Yeah.
And our real trick as a company is we'll tell you when the time is right to switch to commercial. And so you can help them, safely invest in residential. It's much harder to get that wrong, by the way. And but you don't just stick at it. You don't keep buying that only. Get a few properties, leverage, and then once you've leveraged for 3, 4, 5 years, you've got a fair bit of equity, hopefully, depending on the cycle. And then we like helping them hand them over to the commercial department. And then you diversify, do that a couple of times. You're already halfway there to achieving your goals, depending on how
and that's
extreme
super
they are.
strategic, right? And it's good to chat about commercial, which we do, but still very much the lifeblood of all property investors that they start in resis. Welcome back, Phil Tarrant, chatting with Scott O'Neill. Now, so this sort of misnomer a little bit that Rethink doesn't do resi anymore. You still do a lot of resi, and a lot of people who contact you probably will start in resi. Do you still get excited around resi deals? Like, do you sort of look at them, and I know you got a big team and stuff, but like, do you go, resi? I'd say, mate, I really like commercial deals. It's a resi deal is pretty cookie cutter. There's not really, they're probably not as sophisticated as a commercial deal. There's probably a lot less moving parts as part of your due diligence with resi deals. Does it sort of still move the needle for you? You like a good deal still?
Look, anyone that's ever worked with me knows that I get excited over the smallest deal versus the largest one. It's someone getting over the line with a property. It's like there's been points in the past I've actually much preferred the cheaper ones getting it done because they're harder to get done. Because there's less stock, so the pressure's off. Like I feel a lot of pressure when a client's come and they've been waiting for a while. Like you want to sort them out, like because you're indebted to them until you've got the job done. So we've been doing this for 10 years. We've probably done more residential properties than most out there, even the bigger companies. And I remember when we were targeting, say, the Brisbane market, it was back in 2015, 16, 17. It was very flat, and we always we invest for value. We see where things are a little bit cheaper from a national point of view, and we know it's going to play catch-up growth. It's a very simplistic way of investing, but it worked. It allowed us to pick the Tassie market back in the day. We've been heavily investing in Perth before this last 20, 30% increase. We've already got our eyes on more value markets as well. Like you invest for value. Like you can get really caught up in statistics, but you can skewer them around any way you can argue. But and you're the same. I've seen how you've invested. You go where things look quite affordable. Make sure it's not the worst suburb in there. Make sure it's a good house, freehold, preferably, and then you get in and just sit through a cycle. And it's amazing the growth you get because it might be flat for a year or two, like for Brisbane in those years, and then it just went through the roof.
Yeah.
And then everyone had one or two deposits, and then they took them to Perth, and then that's gone up, and now taking them to the next market. And you do that through a couple of cycles, having a national frame point. We're national, like we've got people in every area, every state. It just gives you a bit of a leg up from these sort of one-stop shop people only based in Sydney or Melbourne, or they're just only targeting higher value assets because we're still yield seekers. The yield's not great in residential. Like you're looking 4.5%, 5%.
So how do yields compare? Like over a 20-year period, I know you're a big numbers guy.
Yeah.
How do yields sort of compare over a 20-year period from resi to commercial? Because again, there's this myth around commercial investing that doesn't grow as fast as resi from a capital point of view.
Yeah, look, I'll open this.
Look,
computer.
he has a pre-prepared technology machine.
So we've actually, because when we did the book, we commissioned a study into the square metre rates for commercial buildings because it's very hard to get long-term growth for commercial. You don't just get it off CoreLogic. CoreLogic, it's all there. Resi, it's beautifully covered. There's 10 different companies that do that. But you try find average values of commercial growth over a 30-year period, they're not there. Like you might get a snippet of it over a 10-year period through like a Collier's report or a CBRE, but that's the higher price point. So numbers are often skewed towards the institutional grade there. So I wanted to really compare the growth rates and we'll publish this, but like high level, if you want to know the top market for any asset class in any capital city, it's Sydney industrial from 1995 to 2023. The reason we're 2024 now, but that's where the stats got us. That hasn't been released yet for this year, but that's grown at nearly 7% in that same period. Sydney has grown at 6.62 through the exact same period, quarter to quarter over that, almost 30-year period. And it's kind of obvious when you think about it. Industrial's had an incredible 10 years. It would have had a few slow periods like any asset class, but the extremes are greater in commercial. And this is another thing to really take note of. Like residential tends to be a little bit more consistent, flat. It's less extreme. Like you're going to get examples where it's extreme, like Perth right now. Like that's extreme growth.
Yeah.
But you're getting some areas went 50% growth in 2 years in industrial, and some retail areas did quite similar results. Office, it's doing the opposite. It's dropped about 20% in some areas. So, if you're a commercial investor, you still got a plan to invest for the long term. Do not buy anything if you plan to sell within 10 years, because if you mistime the cycle, you will not look good on paper or in reality if you actually
commercial.
sell. Yeah. And I think same goes to residential, but it's the extremes are less. Like I've never seen any residential market drop 20% unless it's a mining town like Moranbah or somewhere like so.
Yeah.
So there's
people still stuck there. It's horrible.
Their loans are larger than their mortgage. Their loans are larger than their asset value. So and that can happen, but it's rare in residential. So the other reason we like staying quite close to residentials, it's just the vacancies are lower. They're going to be more regular, so you'll have more vacancies in residential, but commercial, you get it all in one hit. And that's where people feel their darkest. So the horror story you get in commercial is you've lost your tenant. They may have been there 10 years, but then you've got 6 months of nothing coming in. And you need to cover the mortgage. You're paying your rates while that's happening. Like it's not a great position if that's the only property you have. You'll feel like you screwed up in that moment. The trick is you got to hold through. You don't fire sell this thing vacant. You don't really get those moments in residential. So this is, again, why we want to start people in residential, because it's easy for me to go, be calm. You're going to be okay. That it will tenant again. It might take you 6 months, might take you 1 month, who knows. Residential, you've got another tenant in 2 weeks. That's a lot easier to stomach.
It's just a lot more forgiving.
Yeah, and if you reach that moment, and I've seen it before, if someone gets caught out in commercial and they've got no investment experience, they're probably never going to invest again.
Yeah.
They'll be just one of those guys that...
Once bitten.
Yep, exactly. So you learn the ropes in residential, do it with professional help, or at least learn yourself. So you're not learning, but you're gonna just take action first in that space.
Are you like one of those buyer's agents that's super cagey about where you're buying?
A little bit,
Yeah.
because you got to be now, because there's 3,000 buyers agents, and I know they hunt in packs now. So
They hunt in packs.
an example is
Tell me about this.
All right, so a lot of them all use, like the new generation ones, they all sign up to the same data companies, hotspots, and then they get pumped that hotspot, and they all go there. And it's a self-fulfilling prophecy. If 50 buyers agents are all targeting a suburb and there's a couple of hundred houses a year selling in there, price goes up.
Yeah.
But long term, my worry is, will that value hold? Because those investors are all investors. It's like the classic, this is old school stuff. You want to go where owner-occupiers invest, not where it's 90% investors. That's a mining town.
Yeah.
So I don't know. I just got to be a little bit careful in that department, because you can create... Yeah, like if I start going, oh, we're all targeting this city, and then you start, and then 2 other big buyers agents do it, like that market will grow. It'll spike.
Yeah.
It has to.
This is like, you get different people see the world differently, but how important, like how individual is your secret sauce, right? Like what do you know that no one else knows? Everyone's got the same data.
Yeah.
So really it's the interpretation of the data and your ability to synthesize the data and actually take something from it which is executable.
Yeah.
Right. And someone could look at the two people could look at the same set of data and have two very, very different, rationalizations of that data. So what is the actual uniqueness? It's the ability of the buyer's agent or the property strategist to actually interpret data better than someone else and not tell anyone else about it, or actually have that advantage for a period of time, you know.
Well, look,
And eventually, if you're in early to a market as a buyer's agent, you want the other buyer's agents to come in once you've gone through. Really?
yeah.
Yeah.
So talk about it after.
Talk about it after.
But look, I'm going to be a bit of a cynic here again, because I know this industry so well. Like, I've lived and breathed it nonstop for 10 years.
Yeah.
Selling data is a marketing strategy, and you can overcomplicate things. This is a pretty unpredictable asset class. You can go into and go, oh, the vacancy rate's sub 2%. That indicates it's going to grow, $40 a week rent over the next 12 months. Like, you can get really ingrained in that. But smart buyers agents, and there's plenty of them, has used data to then go, all right, that's my marketing tool. I'm going to then be a data buyer's agent. That's a differentiate. It splits them apart from some of the guys that just say, I'm an owner rock guy, or and I've seen the various different justifications, and a lot of it's really good, and there is logic to it. But at the end of the day, like, if there's one thing you go off, is no one gets it right. Like, the interest rate prediction is the classic case. You've got thousands of people working at the RBA, and they don't even know what they're going to do next month, let alone the CBA analysts. Like, so trying to become an economist in this space and predicting a market's going to go before anyone, it's a marketing tool. It's a good one too. I buy into it too, but I just try to seek value. A yield is a good indicator. Like, if it's above average yield for where it's been long term, that's a good indicator. People chase value when interest rates go up, and then they chase capital growth when they drop. So they'll go into the more lower yielding cities, and everything runs in cycles as well. So I think you just got to be a little bit more simple and not get too caught up in the decimal points of some random, time on market stat, because it's not going to change your life.
So you
my 2
don't,
cents.
so you don't need a buyer's agent and do it yourself.
I think you need a buyer's agent to get access to stock. It's pretty hard to get, like, especially in the commercial space. Like, I know.
If it's on the platforms, it's probably not good stuff, right? The good stuff probably gets sold before it goes on the platforms, yeah? Same with resi. Do you do in your resi side of things, because everyone sort of talks about off market and pre-market and all this sort of stuff. Like, are you getting that stuff? Like,
So we're probably in the resi space about 50% off market. A lot of even our clients from nearly 8 years ago are selling. So we're dealing with internal stock as well. Okay. So that helps. We're in with a lot of the big rental managers, so they feed us as well. Like, so all the stuff all buyers agents have. There's no secret sauce. It's a pretty simple business, and that's why so many people are getting into it. But commercial, we're probably about 70% off market. That's there's a lot more true off markets in that game, and it's because it's just a less mass-produced product, so they don't need to show the masses. They just need to know whether maybe the high net worth buyer is. We have those. You're negotiating against one person. It's a good story.
That's good negotiating rather than throwing it. So on the resi side, where wouldn't you be buying at the moment?
I'd be avoiding the lower yielding markets at the moment, because I don't think the cost of debt is going to go down.
I asked where.
Oh, Sydney.
Yeah.
I think Melbourne. Melbourne's going to become good value at some point.
Yeah,
See, I like markets where it's dropped. You people go, oh,
It's quite an aggressive question then to you, sorry. But, I didn't ask what, I asked where.
Yeah. No, but like there's markets that, if it's dropped and there's been a bit of value, you got to go, what would change the tide? You don't just go, oh, it's dropped 30%, now it's representing good value. Like, in a way, that's kind of why we're in New Zealand, because it's better value than what it was 2 years ago. There was no chance I was going to push my business to New Zealand 2 years ago when they had a government that was anti-property, the record growth after COVID, like things were hitting record after record. Like, that's the type of market I don't want. I don't like setting records when I'm buying a property. I want to get a good deal, and this is why we liked Townsville many years ago, because it was you were buying at the same price it was 10 years ago. And I'm thinking, well, average incomes have grown, the vacancy rate's tightened, it's way cheaper than anything else in that part of the world at the moment. So it represented value. like from a historic point of view. So
Yeah.
and then it played catch up. So just those types of areas where it's just hitting new records. I'd try avoid those.
Duck and dive. And you're obviously out in Perth with every man and his dog.
Yeah, and look,
Yeah.
Perth comparably still got legs in it because
Yeah, I want to talk about that because I asked someone this the other day, like when is – I remember when the City Mark was on a run back in 2013, 14, it was the big question was, when do you stop investing in Sydney, right? And then there was a point in time where we went, that's it. It's, you might invest today and you might get, a few percentage points increase on it, but you really miss the real game, right? So it's the wrong place to deploy your money. I think we probably moved up buying in Brizzy probably about the same time you did, sort of maybe 2015 time. And it took a little while there. So when are you going to know when Perth has done its run and it's time to stop? Because smart people will stop at a particular time and then people will still continue to buy there. And they're going to be thinking, Perth. Someone's going to buy at the top of the market. Here's a hot tip. Someone's going to buy, people are going to buy at the top of the market and they're going to go, oh, Perth's crap,
Yeah.
So how do you make sure you're not that person?
All right, so the minute that you look at the other capital cities and go, well, Perth looks expensive, that's time to not go there. So you know how like Hobart's dropping in value and like that was way more expensive than Perth and it's played catch up. People would have went, well, Hobart's 200 grand more than Perth for the average house. How does that make sense? So, there's catch up Perth playing. I think when it looks unaffordable on a national side, that's kind of the indicator because they all run in cycles. And especially now that there's a mob of buyers agents and investors, they just float around willy-nilly to any capital city. So if Adelaide looks cheap, they're all going to flock down there. If it's too expensive for their clients, they're going to target all the major regional centres, whether anywhere. That's why Melbourne at some point will be value, but you've got to remember what's changing the value. There's less incentive as an investor to invest there because of the land tax. So remember all that cash flow that's been added to your cost, that's technically going to take it off the yield. You've got to factor that into the price. They say, it's a buyer's cost, but it's a seller's liability. And that's going to hurt them for a while. And if they reverse that decision, straight away it's going to get the excitement back into that market. So, watch what happens in that government. Like if they try and incentivise things, that'll be a good story to get in early. When Perth is too late, it still looks cheap, I think, in many areas. But it's starting to, I think when it starts to look similar to Brisbane again, you go, I'll go Brisbane. There's that kind of.
Well, there's always this
investor
logic
decision.
of saying, why would Perth be so much cheaper than Brisbane? Like Perth and Brisbane should be about the same, is what people say. It should be about the same value, but
And
it's
that type of
so
thought
undercooked.
is the essence of how I invest because the masses make the decisions. Remember, it's not the guy with the stat going, it's what the mob feels.
Yeah.
When the mob feels that Perth is cheap, they're the hundreds and thousands of people that'll be pushing value up because they can afford it. The income, like we all know, is the average income in Perth is more than Brisbane.
Yeah.
Yet it was like 200 plus thousand cheaper, similar populations. Where was the logic in that? There was no logic. It was just a timing issue. They were trapped in by COVID an extra year or two. People didn't want to invest there. The classic, it's too far to fly there. There was enough reason not to invest. People have got over that. Now they're pumping it. Brisbane's kind of, peaking in some areas, but, it'll eventually look cheap when rents go up.
It will do. And if you're a smart operator, you go and tune into the Smart Property Investment Show probably about 3 years ago, and I reckon probably called it within a couple of months of when you should have started buying out there. So keep tuning into the Smart Property Investment Show, and we'll work out where you should be next. Because there's nothing glaringly obvious out there at the moment. Like Perth 3 years ago was like, okay, all these things, it's going to move, and it's just really a matter of timing, and how confident you were that it was going to shift. If you got in early, great. You're saying you can still get in there. I don't really have an opinion on that. I'm not qualified for it, but there's nothing really other than maybe Victoria with the caveat that there's need to be some significant changes to tax reform. You need tax reform out there. But there's nothing really just sitting there going, this is the next big thing.
No, and that's
I can't see it. You know, it just seems to be it's going to be a period of just sort of subdued but predictable growth moving forward. There's no Hail Marys out there.
No, but it's a really good point because that's exactly my sentiment. There's no like hot spot in that. But what will be the driver of growth is affordability because you've still got this mass amount of investors wanting to deploy money. You've got the transfer of like baby boomer wealth going to the kids at some point. So a lot of money will be going into real estate. I think they'll be targeting good value assets. So, you know, like Perth looks cheap. You can buy a house there for 600, 700,000 in a decent area. That'll get targeted. Brisbane, if it's 800 or less, like in a good suburb, that'll get targeted. So that lower end of the market will get, I think, heavily targeted. And as an investor, you just plan to hold for at least 10 years. Do not buy any of this stuff if you're trying to flip it in 5, because by the time you pay stamp duty, there might be a slight correction in the market if something bad happens.
Can you make money flipping property as a property investor at the moment? It's a lot harder now, isn't it? Those days are gone.
Go to
right?
America if you're trying to do that type of stuff.
Yeah.
Like, it's just the wrong tax structure, and it's you make money through.
Yeah, you get hammered, right? Like you got to hold a property for at least a year to get your CGT discount, and to try and get a builder now is tough. Building materials is really expensive. Like, you know, there's no one. If you sort of go back in time, probably 15 years ago, there was people flipping properties all over the joint, right? Quick, cheap, dirty renos and flogging them off, and that was happy days, right? Haircut and a shave.
Yeah.
They're gone. Those days are gone.
Yeah, I think if you look in the eastern suburbs of Sydney, like they almost go for a premium because people want the opportunity to do a reno.
Yeah.
Like, because there's a lot of that entrepreneurial wanting, like that money, like make something out of something is a premium in many markets, and then your bill costs double through that period too. So it's a hard slog to do well in that financially.
It is. So steady as she goes. That's the summary from Rethink Investing, is it?
Yeah. Just
the resi space.
Target value. Don't sell anytime soon, and look, cash flow is the key. If you've got a stable job and you've got the ability to weather, you know, it's going to cost you $5,000 to $10,000 a year to hold a property at an 80% mortgage.
So that's simple math. $5,000 to $10,000 a year per property.
Yeah. So if you target a $750,000 house, you'll need 20% of that. So 140, you'll need to put your stamp duty in there, about $60,000. So you're in the hole for about $200,000 cash. So you need $200,000 to invest in a $750,000 house. I'm not looking at 90% loans, but that is also an option. By the time you take your couple grand out for property management, $2,000 odd for insurance, your rates $2,000-3,000.
Yeah.
You know, add all that into it, you're going to be negative about $7,000 to $10,000 if you're getting a 4.5% gross yield. So the yield is going to be 4.5%, but you take that extra $10,000 of costs out of it, you're into the 3% nets. And this is important to note. Like, a lot of residential investors don't look at net yields. Like, a net yield is what you're really taking home. Gross is, I don't even know why we quote gross, to be honest. It's like half the equation.
So net yield is your mortgage costs and all costs to operate, right?
Yeah, so there's net yield on the property itself.
Yeah.
So that'll be about 3.5 in residential. Commercial's 6, 7, so it's about double.
Based on the purchase price.
Purchase price.
Yeah.
That's before mortgage.
Yeah.
Because that's a variable that only the owner controls. So, you know, if you 80% mortgage, that house example I just mentioned, you're negative $7,000 a year. So, you know, your mortgage is the real reason that's gone negative. Otherwise, it's plus 3.5%.
Yeah.
So you can 90% that, and that's a great strategy if you've got a good job and you've got stability, because then you can leverage. And that's the greatest power of residential property. That's where commercial cannot compete. It never will, because you could stretch that $200,000 into a $750,000 house. And look, you can get 80% loans in commercial. It's rare. But would you want to do that on your first property and then the property goes vacant in 5 years' time? Probably not. It's just stick to the basics, cop that $5,000 to $10,000 negative a year. The rents will grow. And then if you get your 6 or 7% growth long-term compounding, you will make enough money to then transition into other asset classes.
Sounds simple.
Simple but lengthy.
Yeah.
Yeah.
You need patience. I call it strategic patience, which often a lot of property investors don't have. But good to catch up, Scott. Maybe we can get you back on, talk a little bit more about property on the Smart Property Investment Show.
Hopefully, that wasn't too rubbish, mate.
No,
Tick
I
the
think
box.
it's okay. You know, it's so there's so many. I'm trying to keep buyers agents away from the show. They're just everywhere these days. But you know, we think at Smart Property Investment that buyers agents do good work. And the point I would make is that not all buyers agents are created equal. And if you could do it all yourself, you know, I've used buyers agents. I buy stuff individually. You know, and if you are using a buyer's agent, I'd probably ask the first question, tell me about your portfolio, is where I would start.
Yeah.
It's probably a good spot to start.
Yeah.
They'll give you a
market
lot of clues.
is a key. And
Well, when did you buy your first investment property?
2010.
Okay.
And it was a good time to buy because it shaped how I thought because it was a very bad year for property. Probably one of the worst years Sydney's ever seen.
Yeah.
And I that's pushed me towards more of a cash flow goal because I just wanted to. I assumed I was going to get no growth, but I wanted to get into the market because I didn't care what happened in that year or the year after. Long term, it'll grow. Yeah, it's a given. You know,
you've done well over 14 years. Like, you know, it's quite familiar with your portfolio, man. You're not short of a buck. You've created a lot of wealth in 14 years.
Yeah, but look, it's not rocket science, and like you know, again, there's no guru out there. Like again, I'm a realist. Like it was a bull market. I just took action, and there's many others that did the same thing.
I'd have that every day of the week, right?
Yeah. And it's the whoever's done the most moves in property generally has made the most money. You know, like, and I was redlining. I was using as much debt as I could.
You're using credit cards for a point there, were you?
I covered half a deposit for one once. Yeah, but it was a deal. I just had to get it. Like we mentioned in a previous podcast, that, you know, it made $500,000 on the purchase. So did I do a silly thing? Probably, but I had an engineering job that I knew I wasn't going to get sacked that week. Yeah. So
risk and reward.
Yeah.
I wouldn't recommend you do that sort of tomfoolery, but you know, if you back yourself, give it a red hot crack. But buyer's agents, just you want to work with someone who's been at it for a little while and has evidence of success. That's put their money where their mouth is. Because there are some buyer's agents out there who never bought a property for themselves. They exist now.
Yeah,
that's crazy.
I know, and
this is like the next generation of buyer's agent, which I'm not putting down. There's some very good operators out there, by the way. But you know, like you've got your sort of OGs, and then you've got like I reckon this second generation, which I'd probably put you in, guys like yourself, and you know, a cohort of other people. And now you've got this sort of third generation coming through.
You know where it'll really get interesting when there's the first proper recession, like because all the buyers agents that got through the GFC, a lot of them lost a lot of properties. So this will be the moment, like, you know, it could be a couple of years away, who knows. That'll sort out who's invested properly and who hasn't. Because there's a lot of, you know, like I mentioned, it's been a good market. So obviously you can make money. So you can maximize your debt. Like I could probably go out and buy an extra 20, 30 mil property today with my debt levels. But am I? No, because I just need, with my size portfolio, with the amounts of things going on, like I've just got to be ready that if a bank wants to call a loan in, I've got it covered. So, and I know there's a lot of people out there that are just maximizing. I maximized when I knew it was safe. I just don't think when you get to a certain level, you should do that.
But the thing is also, it's like, do you really need it? Like, do you need any more? Like,
no,
you don't, right? You know, if you do nothing now, you keep your debt level the same and wait 10 years. Yeah, I'm sure you've done the calculation. Like,
well,
I think you're going to be okay.
Well, look, the portfolio is sitting, 85, 90 mil. So if the average, like I'll make 6-7 mil in capital growth a year.
Yeah,
just by doing nothing, and then there's cash flow surplus.
It's pretty good going.
But yeah, like you said, do I just get and buy another? Like, what's the point? It becomes a bit of an admin task, which we've discussed again on that. Like the poor wife gets smashed by, I think we've got 68 commercial tenants as well. So there's you've got to be really read up.
Hard
to manage.
work, 68 commercial tenants is a lot.
And they've all got different leases. Like right now, we're negotiating against Chemist Warehouse, Foodworks, Audi. Like these are tough negotiations.
You've got an Audi dealership, have you?
Audi, the supermarket.
Oh, yeah. Aldi. Okay.
Probably even harder to negotiate.
Yeah, probably. Yeah.
The Germans,
the Germans.
They're solid.
Yeah.
They're solid.
They're right. They know what they're doing. I like Audi. Yeah, it's be careful what you wish for, right?
Yeah.
It sounds horrible,
But it's like any other business. So,
It's a business. It's
yeah.
a business.
And a lot of people prefer, I'd rather have my small franchise business. Some want the big head office in the city. It's a choice.
Yeah.
But yeah, you just got to manage it properly. And but yeah, like I said, when there's the big first recession, it'll be very interesting to see what.
So is that a
comes out of
given,
that.
or you just
I think
prepare? Yeah.
Oh, there always is.
Yeah.
It's just we haven't had one for 15, 16 years. So
Well,
it'll happen.
0.1% GDP growth, right? Like,
and the answer is like, how will it affect properties? So sometimes it doesn't. Like COVID didn't. GFC was fairly benign on property in Australia.
so only because our banks were so strong, right?
Exactly.
And our banks are still as strong as, if not stronger than what they were back then.
Yeah. But think
the governance of all of our banks is and the central nature of property as part of the Australian economy is like.
Yeah.
I saw Harry Dent's coming out again, telling us there's going to be, he reckons an 85% drop in the NASDAQ and a halving of property prices or something other.
Get him on the
America.
podcast.
Yeah, he's too smart to me. I don't want to debate someone who is so intelligent, when I'm just going, oh, okay,
Well, look, I think we at least know the next recession's probably not going to be a banking one.
No.
We've got really good banks, and that's the difference with the US and what happened in Australia. But what if there was a war on our shores and people lost confidence? Like, you got to think, what could actually cause harm to property? The answer is not much because we're Australia. Everyone wants to live here, so that's a great reason to get in and just, if there is a recession, you just hold through it. So it's a cash flow management issue.
It has to be something seismic like that. And I was having dinner last night with a pretty senior politician, and the conversation was, part of it was really around that. It's this growing acceptance or appreciation, or the collision now with everything that happens in Australia with geopolitics and security, national security and national resilience. And there is an application for that in property markets. Should really do a podcast on that. But, what would happen, like the security environment to change so dramatically that property prices drop by a half, and if property prices drop by a half, imagine half of all people in negative equity. Imagine what that would do to the banking system.
Yeah.
That's catastrophic, right?
Hyperinflation.
It's a
You'd have to
hyperinflation,
print money, cover the debts from the banks.
Yeah.
And, in the long term, that would help property. But yeah, it'd be your money would be worth nothing.
Your money would be worth nothing. So it's good for property, but if you've got $1 million loan on a property worth $500,000, if you can continue to service the debt, okay, you're fine to weather it out and maybe buy some more if you've got some spare coin. But that wouldn't be the norm. That would be, most people are probably redlining, I would imagine. So anyway, but
Time will tell.
Do you know what we should do is how they do alternative histories and stuff. What would have happened if XYZ, this didn't happen. Maybe we could do something with property. Imagine if that didn't happen, what would have happened?
They didn't bail us out in COVID.
Yeah. What would have happened? Alternative histories. No JobKeeper. What would have happened? Would we be in a better position today than where we are right now? Would we have inflation at levels that we did? Who knows? That's probably need some smart people to do. You're okay. You got an engineering degree, but blokes like me who don't really know what's going on. I reckon you get some boffins in to run the numbers. Yeah. That'd be interesting. Anyway,
sure.
That's Scott O'Neill, Rethink Investing, back on the Smart Property Investment Show. People can find you if they want to track you down. Just Google you, I imagine.
Yeah, just Google Rethink Investing.
Yeah. Or Rethink Everything. Rethink Everything. What do you do? Everything. Rethink as the service, though. It's good.
I think there's an American company called that, so not that one.
Oh, yeah. Nice one. Go and check these guys out if you want to have a yarn of them. And New Zealand stuff's interesting. We'll pick that up.
Yep.
Have a chat. But thanks for tuning in, everyone. It's sort of an hour. Wow. I'm probably late for my next meeting, which I assume I am. Thanks for tuning in, everyone. Remember smartpropertyinvestment.com.au. Smart Property HQ is where you find us on social media, or if you're an Instagram person, Smart Property Investment, track us down. Like us, follow us, see what's going on. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.